Good evening and welcome to the first session of our Autumn Term Money webinar series by the Institute of International Monetary Research in collaboration with the Vinson Center for the Public Understanding of Economics and Entrepreneurship at the University of Buckingham. I'm Juan Castaneda, Director of IIMR, and today we'll be hosting Professor Charles Calomiris. Professor Calomiris is the Henry Kaufman Professor of Financial Institutions at Columbia Business School and a Professor of International and Public Affairs at Columbia's School of International and Public Affairs. He recently served as Chief Economist and Senior Deputy Comptroller at the Office of the Comptroller of the Currency. Professor Calomiris is a member of the Financial Economics Roundtable and the Shadow Open Market Committee, and is a Research Associate of the National Bureau of Economic Research. Well, today we'll discuss, does the Fed need a tighter monetary policy and Congress scrutiny to restore price stability, after which we'll allow time for Q&A with viewers at home. So Charles, the floor is entirely yours. The session is going to be recorded, but not the Q&A and discussion. Thank you very much.
Thanks. It's such a pleasure to be here, and I know that many old friends are tuned in. I heard about the guest list, so welcome to all of you, and hello to all my old friends who are tuning in. I want to make some introductory comments, and then I'll talk for about 20 minutes, and then I hope to field questions. My introductory comment is that my presentation is going to be entitled "The Need for Systematic Monetary Policy." So it's not just going to be about the obvious fact that the Fed is currently behind the curve and other central banks now with the Fed are trying to catch up with extraordinary increases that really reflects their prior error. But instead of just focusing on the current need in the moment, I think making really much more deeper and important points if I emphasize how we got here. The way we got here was the absence of systematic monetary policy. My other introductory comment is that I want to dedicate my comments today to my late friend, Alan Meltzer. And those of you who knew Alan and who knew his work will recognize that I'm very much channeling Alan today in my comments. In fact, I make specific reference to a few of his works, but generally, I think I'm going to manage to not deviate one iota from things that Alan must have said 100 times or maybe more over the course of his brilliant career. And these are not original comments of mine today, but very much reflect the influence that Alan had, and many others, of course, on me as a thinker. So when Alan would start a session about why systematic monetary policy was needed, and usually pointing to the moment, whatever the mistake of the moment was, that wouldn't have happened if systematic monetary policy is in place. And by the way, I can come back to this, but the way I like to teach this is I often collect up news events for my students of major problems. At the end today, I'll talk a little bit about the head of UNCTAD's recent speech on monetary policy, or about the taper tantrum. I have a whole case in my class about it. And the way I like to teach them is these are news events that wouldn't have happened if we'd had systematic monetary policy. And they're very disruptive, episodes of extreme risk. And they tend to be associated with waves of, unfortunately, excessive buildups of debt, as we're experiencing in emerging markets today, followed by financial distress produced by the news when the Fed decides to tighten. And I think the key thing we need to understand, advantage to our society from having a systematic monetary policy, would be less news. And news is almost never a good thing. That is, if we had less of it, it would mean that the markets were able to anticipate much better what's going on. There wouldn't be the kinds of disruptive excesses of buildups of debt during low interest environments, unwarranted low interest environments. There wouldn't be the kind of contractions in global activity, the sudden movements and financial disruptions. And that's, I think, the moment right now, that's really what we need to be thinking about. What we wouldn't be experiencing if we operated under a different kind of monetary policy regime. Now, Alan, of course, in his brilliant 3-volume history of the Federal Reserve, liked to start his discussion of this topic by pointing to the fact that the Fed had a very poor track record. In fact, with the exception of a few years in the 1920s and some of the 1980s, 1990s, and early 2000s, which was really only about a quarter of the Fed's first century, you could say that it managed to achieve its objectives. And if you're not familiar with his books, I recommend that you read them. And that, I think, is a pretty important bottom line to start with. The Fed has not been a successful institution overall. It has not achieved its objectives about 75% of the time, and now more, because we would have to say that over the last several years, and maybe you'd say a decade, the Fed has been extraordinarily bad in meeting its objectives. And I think that we're living through the problem that came from that excessive low interest environment right now. But it's really important to mention this is not a one-off. This is the history of the Federal Reserve about 75% of the time. That's an important place to start. And then the next thing that Alan would typically say when he was reviewing this history is, really, when you dig into why the Fed has made its mistakes time and time again, there are two influences that seem to be the most salient ones. And they are faddish ideas about the economy that shouldn't really have much currency, but do within the Federal Reserve. That is bad thinking. And secondly, politicized thinking. Politics, of course, has been poison for central banking since a very long time. And in the United States, it's continuing to be. So let me talk a little bit about this, because you might wonder, are these problems still present? Of course, we know that the history of the Fed, with its particular view toward net-free reserves and these terrible sort of policy apparatus that they had in place in the 50s and 60s, but we've graduated from that. We're much smarter now. So this first problem of bad monetary policy modeling certainly can't be present, right? Well, of course, it's very present. If you look at the Fed's forecasting, it was systematically under-forecasting short-term economic growth during all of the Trump administration, over-forecasting it during much of the Obama administration. And we could say that their forecast errors have continued, of course, quite dramatically in the Biden administration, and their forecasts of inflation, of course, have been catastrophic. So we'd have to say that they have done much worse than a coin toss in terms of their forecasting models. What's the problem from a technical side? I would say we've seen that, first of all, the Fed doesn't have a very good way of incorporating the financial sector into its macro models. The so-called DSGE modeling, of course, has recently tried to correct that, but I'd say when you look at that model, it's laughably bad. And then if you look at more generally, simple things like, how does the Fed view the effect of fiscal deficits on inflation? Some of you may be aware Larry Summers recently joked that he asked his research assistant to calculate what the current huge fiscal deficits that the US government has been running, what effects they'll have on inflation. And when his research assistant told him what the Fed model says the answer is, he told his research assistant to throw the Fed model in the trash can. I think that was a very appropriate decision, by the way. I'm just surprised that he hadn't made that decision years ago to throw that model in the trash can. So I think we'd have to say that the Fed, its models have not done a very good job. And part of the reason for that, I'll come back to this at the end, is that it's hard, very hard, as Alan Meltzer also pointed out, for Congress, which has the responsibility of holding the Fed accountable for its modeling. It's very hard for Congress to hold the Fed accountable for its modeling, because it's very hard for Congress to ask pointed questions about the Fed's model in the context of a congressional oversight. And I'll show in just a few minutes how a systematic monetary policy would allow the Fed to be questioned more about its actual economic beliefs and its model. That is one of the main advantages. And the reason why Meltzer pointed out, bad modeling has been a major contribution to Fed bad policy. And part of the problem is there's not enough accountability for the Fed in the way it models the economy. The second problem that Meltzer mentioned was politicization. I think it's fair to say that the Fed right now is more politicized than it has been at any time since the 1970s. If one wants to understand why that is, it's a long story. Part of it is the Fed's increasing regulatory powers, which have happened over the last 20 years, and has made the Fed a lightning rod for the politics associated with bank regulatory policy. And that, I think, has been very pernicious for the Fed. You can see also this increased politicization in a lot of other symptoms. One has been Chairman Yellen's discussion of inequality, which many economists thinking, why is the Fed talking about inequality so much? That's not part of what monetary policy should really be focusing on. And then now we have Governor Brainerd, of course, again, really one of the most politicized people we've ever seen at the Federal Reserve Board, constantly talking about climate and financial risks, which many of us think is very overblown in terms of climate risk for the banking system. The banking system makes short-term senior loans. Climate risk is really not of much consequence for thinking about the banking system's risk. So these kind of invented issues and problems that the Fed has seen itself recently focusing on are a symptom of this problem. Also, the centralization of power at the Federal Reserve Board, which has happened partly as a result of legislation and partly because of just politics, has led to a reduction of dissents, which many people have noted has been true for the last really 25 or 30 years. There's been a continuous reduction in dissents at the FOMC meetings, and also a reduction in independent voices of Fed presidents. We used to depend on Fed presidents as independent voices, and that partly reflects the fact that the Federal Reserve Board is now abusing its veto over Fed presidents to actually now control who is appointed, who is suggested. This is a complete abuse of power, and it reflects, again, the extreme politicization that's going on at the Fed. So I think that we'd have to say right now that the Fed's failures, as has been really throughout its history, the cause of its failures have been the same two that Ellen Meltzer has pointed to: bad thinking and politics. So how would a systematic monetary policy approach help? Well, first, by forcing the Fed to say what it's doing in an explicit way, it would help the Fed to focus on what it can and should do. And doing that actually would free monetary policy rather than constrain it. It would free it from politics. And it would also help improve thinking. Why? By creating a framework that could be questioned so that we can all have discussions about how to improve the thinking at the Fed. If you actually write down your framework, you're insulated from politics. Why? Because your actions reflect an independent and economic assessment, and you can always reference your framework when defending your actions from political interference. And of course, that's a very old point that goes back certainly to Milton Friedman and Anna Schwartz and others who talked about this topic 60 years ago. Not only can you free up monetary policy from political interference, but as I said, you can improve it by having people able to have discussions of that. So FOMC meetings would no longer be just exchanges of opinion about what the Fed should do, but actually discussions about what parameters are in models that they should adopt, what estimates from the different Federal Reserve banks say those parameters would be, which kind of equations they'd want to include. And so it would make the whole discussion much more substantive. And then, of course, as I'll talk about more, it would make congressional questions of Fed officials that appear before congressional committees, again, much more substantive. Instead, currently, they're not very substantive. So what would a framework involve? It would involve two levels of discussion. First, it would say what the Fed's primary objective is. Now, as people have said for a long time, the primary objective of the Fed should be price stability. The reason for that is no one doubts that the Fed can control the price level, because after all, the price level is the inverse of the value of money. and the Fed has a monopoly over the supply of money. If you have the monopoly over the supply of something, you can certainly control its value. So there's no question that the Fed has the ability to control the value of money, being the monopolist in production of it. Therefore, that should be something that we know we can hold the Fed accountable to, and therefore we should make it the Fed's primary objective. The Fed should also be given a secondary objective, which is countercyclical monetary policy, based on predictable actions which are grounded in rules that are present and enunciated in advance. As I said at the very outset, one of the main other advantages of this is it would reduce uncertainty, it would reduce news in the financial markets and the macroeconomy, facilitate planning, reduce risk, and as I've already mentioned multiple times, it would also reduce political interference and bad thinking. So why would monetary policy be better for us? It would be grounded in better thinking. It would be less affected by short-term political convenience, and it would imply less news that could be disruptive to the market. Those are all the obvious improvements. And I want to emphasize, in case you are 20 years old and you've never heard this before, I didn't invent any of these ideas. People have been saying them for at least 60 years. Now, why is congressional action, at least in the US, why is congressional action needed to get the Fed to adopt a systematic framework? And the simple answer is the Fed won't do it any other way. Bureaucrats like discretion. They like to avoid accountability, and having no rule in place is very good for Fed officials. It's just not good for the rest of us. But of course, they're not going to tie their hands and make themselves more accountable unless they're forced to. In the US, under Article 2 of our Constitution, it's Congress's responsibility to oversee issues related to the value of the currency. And so clearly, Congress is the one that has the responsibility to write legislation that would require the Fed to follow a systematic framework. Now, what actions specifically should Congress take? In my view, the primary objective of the Fed should be defined as maintaining a 2% average rate of inflation. I don't want to get hung up on this if some people think it should be lower or slightly higher or somehow a little different, except to say, I think that's the best answer right now, given that the Fed already has adopted a 2% inflation target. I think continuing with it has big advantages. And I wish they had adopted a slightly lower inflation target initially, but I think 2% is just fine. I would also note that the Fed has recently, many officials have even talked about publicly considering changing their inflation target and making it a matter of short-term policy determination. Of course, that's nonsense. It makes no sense. You have to enunciate your long-term goal as your primary objective. And another obvious reason why Congress needs to do this is to prevent the Fed from, based on some sorts of myopic considerations, to think about changing its long-term goal. Secondly, secondary objective, which should be countercyclical monetary policy, that should be dictated through the Fed adopting some kind of clear monetary rule. Now, I want to emphasize it doesn't have to be a Taylor rule, anything really related to that. It could be very different. They could think about some version of a Taylor rule. They could think about a much more complicated sort of policy based on the processing of information in real time. And it should be up to them to do it. It shouldn't be Congress telling them the expertise resides at the Fed. The Fed should be accountable, and the Fed should be allowed to develop its own rules. It should also be allowed to change those rules over time as it learns more about the structure of the economy, but do so in a transparent way so that at any moment in time, we know what the Fed is thinking, we know what its rule is. There's no reason to just have the Fed say the nonsense of we're going to be data dependent. Show us precisely how you want to be data dependent and have arguments at the FOMC committee about what it really means to be data dependent. And let's be specific and let's use algebra. Should there ever be allowed departures from the rule? Of course. The Fed should be able to depart from the rule. And now you'll see the point that Meltzer was making to the senators and the congressmen during the committee about how having a rule will facilitate oversight. He says, if the Fed departs from its rule, you can then say to the Fed, you announced this rule based on your best research, but then you departed from it. Please explain why. That's a very pointed, specific, and useful conversation to have, rather than the vagaries that currently have, where the Fed officials basically just wait for the clock to be run out and talk in vagaries in response to vague questions. So we'd have the Fed having a clear primary objective given by Congress, having a secondary objective, which is countercyclical policy based on a transparent prior stated rule, and then any departures from that rule would have to be explained. What are some additional things that Congress could do that would be very useful? I think that it would be very useful in the US. We've seen, especially as a result of QE, the value to clearly making what the role of what the role of the Treasury is versus the Fed with respect to the maturities of US government debt. We currently live in this strange situation, which is very different from where we were in, let's say, 2006. So in 2006, the Treasury agreed to keep its accounts in the banking system stable and small so that there would be no uncertainties about the total amount of monetary base that would arise because of unpredictable Treasury actions related to its accounts in the banking system. And similarly, because the Fed was on a Treasury bills only purchase policy as part of its monetary policy, the Treasury had the clear role over determining the debt structure maturity. Now we're in a completely different world. There is no agreement about the size of the Treasury's accounts. And recently, the Treasury has been a contributor to volatility in the monetary base coming from its actions, especially during COVID, we saw this. That has not been a constructive contribution to monetary policy predictability. And secondly, the Fed now, through QE, is sort of second guessing the Treasury's own decisions about maturity structure. What matters is, what is the maturity structure of Treasury debt held by the public? And who determines it? And the answer is, it's currently determined by some sort of undefined combination of Fed actions and Treasury actions. Treasury actions over issuances and Fed actions over purchases. It's just nonsense. So we're now back in a situation where, compared to 2006, we don't have a clear responsibility over monetary policy in the short run because of the Treasury's actions in creating uncertainty over its own accounts in the banking system. And we don't have a clear understanding of accountability, who's in charge of determining what's the maturity structure of debt held by the public. So this also needs to be part of congressional action to make it clear that the Treasury should be in charge of debt maturity structures. The Fed should be getting out of now, departing from purchases of long-term Treasury securities, and of course, mortgage-backed securities, and of course, things like municipal debt. These are all fiscal policy decisions that were inappropriate to be done by the Fed. Some were understandable as part of an emergency in 2008, but of course, we're in 2022 now, and this is a ridiculous extension of that inappropriate fiscal policies by the Fed. I can talk more about that later. I think we also additionally need to pursue the regulatory reform that had been proposed by the Treasury in 2007. Ironically, the Treasury had come up with a wonderful plan for making regulatory policy separated from monetary policy. And unfortunately, when the crisis hit, we went in exactly the opposite direction. So I would say those are also very helpful, especially for preserving the Fed as an independent actor. Because as I said at the outset, regulatory policy by the Fed is a political lightning rod. And it's really been very, very destructive. I want to end by talking about the recent speech by the head of UNCTAD, who of course was calling for the central banks to be compassionate and to stop tightening because of the problems that they're causing in emerging markets. And I want to say, I think that's, of course, the wrong message. The right message is that if monetary policy had been systematic in the first place, there would have been less of an excessive buildup of debt by emerging market sovereigns and corporations during the excessive low interest rate environment. And so there'd be less prospect of financial distress in those quarters right now. And furthermore, if there had been systematic monetary policy, instead of this sudden disruption, this extreme news that we're experiencing right now, what we'd be experiencing is much more predictable policy over the past several years of a more gradual tightening. So we would have had neither the excesses of the buildup of debt nor the excessive suddenness in dealing with the Fed's lagging recognition of the inflation problem. At this point, I have concluded my prepared remarks, and I would like to open up the floor to questions. And I'll ask Juan to navigate those questions for me and just pose them to me, and I'll try to be responsive. And thanks to all of you for your attention.
Well, thank you, Charles, for your very, very thorough and comprehensive presentation. The topics couldn't be more timely. Should I just say that for those interested in Charles's recent books, he is the co-author of a book in 2014 with Princeton University Press, Fragile by Design, The Political Origins of Banking Crisis and Scarce Credit. And he has been the editor of 2 volumes for the Journal of Financial Intermediation on very topical issues, Rules for the Lender of Last Resort, and Assessing Banking Regulation during the Obama Era. And of course, he has many other publications. I invite you to check his website, and I very much recommend, well, the title is very attractive, actually. His next book, entitled Useless History and the Future of Banking, is his forthcoming book, and I invite you all to follow these developments. In order to start this discussion time, we have a comment by the chair of the Institute, by Tim Condon, that I will read to you, Charles. In 1959, Milton Friedman advocated roughly a stable growth of the quantity of money, broadly defined, of about 4% a year to achieve price stability. He said that because he expected broad money to rise about 1% a year faster than nominal GDP, and he believed that nominal GDP would be around 3% a year, that would be in line with the trend increase in real output. Since 1959, broad money has indeed risen by 1% a year more than nominal GDP. What, if anything, was wrong with Friedman's recommendation, in your views?
I think that this recommendation would have been better than what we actually had in terms of monetary policy if we had followed it since 1959. I don't advocate that rule right now. The reason is that I think we can do a lot better. The world has changed fundamentally since the 1970s in terms of the predictability of velocity and the constancy of monetary velocity. This reflects, above all other things, changes in trading of securities, which have complicated money demand. So if you think about the initial formulation of money demand through the quantity theory, there was a quick slip of the from a notion of total transactions in money, the T, to a Y. In other words, GDP. So there was a view that somehow GDP was the source of monetary transactions relating to goods and services. That's simply not true anymore. The within day, huge and volatile amount of transactions in securities markets makes the prospect of coming up with a simple velocity, constant or predictable minor changes in velocity simply not feasible anymore. So my own view is I don't think that we want to be following that kind of rule right now. I think we can do a lot better with other frameworks. But of course, that doesn't mean that monetary aggregates are useless as indicators, far from it. But I think we can say that while they're useful as indicators, they're useful along with many other things. We're really not in an environment like we were in the 50s and 60s, where the income velocity is a predictable variable that we'd want to rely upon so that we could target monetary growth in that way.
Well, thank you, Charles. About this point, I hope you don't mind if I ask you a couple of questions. We just completed, me and another colleague from Spain, José Luis Cendejas, a research on money velocity, broad money velocity in the US on a very long-term perspective in the last 100 years. And we observed that indeed money velocity changes, and it did change quite abruptly before the 1940s. But then those changes actually sort of revert to a predictable mean. So yes, money velocity changes, but those changes are in a way predictable. They sort of revert to the mean. That's we conducted several statistical tests to prove it. So if this is true, if this is the case, you may want to focus on a monetary policy over the medium to long term. And then in that time horizon, obviously, money velocity, changes in money velocity will be much more predictable. So that the Friedman's, as if it were K% rule, would be much more, easier to implement.
Very open-minded to this. As part of a systematic monetary policy, that would be the debate that we would all be having. We'd be having the debate, and some of my friends in the US, like Peter Ireland, who have shown that there's a lot of information in the monetary aggregates. I think that that would still be part of the discussion. I'm not sure that that would be the only variable I'd want to include in a monetary policy reaction function. Particularly, I think I would want to have a richer short-term reaction function, but that would be something that we could all debate. As far as I'm concerned, the main thing we all should be arguing about is the need to create a systematic and accountable monetary policy. And then once we have that in place, then this discussion about exactly what we should be targeting will be something that can be much more pointed and where we can really hold the Fed accountable for it. I think that we also have to recognize, and I know we have lots of questions, but I want to mention, as an economist, it's kind of depressing that we're still sitting here talking about systematic monetary policy frameworks. And I think what that indicates is what a failure we as an economics profession have been. I think we need to prioritize a little bit. Instead of arguing so much in the journals about every little nuance and every little small thing, and I'm not saying your paper is arguing about a small thing, quite from it, right? That's a pretty big thing. But I'm saying we need to prioritize, to put our heads together and to say, no, it's not acceptable for central bank officials to mischaracterize the argument for a systematic monetary policy. They systematically mischaracterize it. And then professors all over the world say nothing. We should, as a group, say, no, it's a mischaracterization to say that the Fed would lose control over monetary policy. That's not what we're saying. It's a mischaracterization to say that the Fed wouldn't be able to change its policy or even depart from its pre-announced policies. Those are all part of the mischaracterizations that the Fed officials and other central bankers use when they speak to this topic with reporters to try to keep us from having a focused conversation. So my point is, I'm happy to have a conversation about any topic in monetary economics or economics broadly, but I really want us to focus on the first step, which is a systematic monetary policy framework. And then we can argue about exactly what we should be doing.
Yeah, we very much agree. That would be a tremendous move forward from the point where we are at the minute is very low, if I may say so. So adding more commitment to the Fed's policy by Congress, because it's the one who has to do it, that would be a massive step forward. I agree. And then indeed, as you said, it is very much for discussion which rule we go for. Which is not precisely the trend we are observing in the last few years. It's because basically I very much agree with your presentation. We've been broadening the scope of what we're asking the Fed and other major central banks to do, and that's putting the Fed in a very tricky position. It's making it much more dependent on politicians and what they go for at each time. So enough about about me and my comments. I'm going to return to the audience. Actually, there is a comment about this question, and he's asking you to be a bit more specific on the type of rule that you favor.
I think those are great questions. What we should be doing precisely. I don't have a very clear answer to this question. That is, I tend to see a lot of advantages in some of the discussions about price level targeting. As I understand it, especially has some desirable features in terms of long-term commitment and also in terms of efficacy in dealing with problems at the zero lower bound. So I saw some very interesting presentations at Stanford about a year ago about it. I don't have a strong opinion. There are many different versions of the Taylor rule. Of course, the advantage of the Taylor rule is that it is simple and there's only one equation. I also want to emphasize something that's come out of some of the discussion, again, that John Taylor and some of his colleagues in Europe who similarly favor some kind of rule, is that there are different models. You could actually weight them. So I also want to say that one possibility would be a very complicated rule that would say that we'd attach different weights to very many different kinds of equations. And so you could think of that as sort of accurately reflecting our uncertainties about which is the best model, so that we might actually use a weighted combination of models. Or another approach would be a rich information environment where we just have a mapping from maybe many different 10s or 20 or 50 or 100 different predictable variables that are being used through the filter of how they affect ultimately the variables we care about. So I just want to emphasize that I am not in the position currently that I have a favorite model. I tend to be very heterodox, I guess, in my views about which way to go here. I can see advantages to the rich modeling framework of many variables or to the simple one. I think the key thing is that once you put down on a piece of paper all of the different models, and that means that it becomes clear to all of us what the Fed is thinking, we can then start arguing about which ones should have greater weight. And we don't have to even think about picking one model. We can think about the Fed simply taking the 10 or 20 different models, or very many different variables, and attaching different weights to them. And then we can all argue about whether those weights should be changed. There's nothing greater than the transparency of the Fed actually saying what it thinks its best guess is, for us to then be able to productively argue about how to improve it. So I'm sorry I can't answer that question better, but I don't have a particular view about which is the best way to go.
Thank you. Yeah, what is really depressing to see, at least in the last few years, is that the Fed, and it's not the only one here, are stating that there is no a relation between changes in the amount of money and inflation. That relation just is off. Actually, it's not in the cards, as if it were. And that's something the chair of the Fed actually said in Congress officially in a response to a question by a member of the committee, that that relation just is gone for in the last 40 years.
It's a nonsensical statement.
Yeah,
remember, and I don't mean to insult anyone, but remember that the chairman we have of the Fed right now is pretty much incompetent in terms of understanding economics. I mean, he seems like a decent fellow, and I think he might even be sometimes trying to do the right thing when he's not under the political pressures that he's been under. But he's just not really a competent economist. That's not what he'd spent his career doing. And political appointments don't reflect economic knowledge, unfortunately. So we have to remember the key point is the Fed is the monopolist in the supply of money. The Fed controls M0. No one else controls it. Even when the Fed is targeting an interest rate, it is implicitly achieving that target through its control over M0. Whatever you think the Fed is doing or should do in terms of its targeting policy, the reason we know the Fed can achieve its objective in terms of the price level is because it controls a quantity. It is the monopolist over M0. Whether the velocity is stable or not, that's not the point. Yes, the Fed, money is what the Fed controls, and it's through its control of the supply of money that the Fed affects everything. So, and if he doesn't think so, he can grant me the monopoly instead. It would certainly help me if I could print money. My wife, I'm sure, would be very happy, and I wouldn't abuse the privilege too much.
Oh, thank
So if
you.
he thinks that having the control over the supply of money is irrelevant, then give it to me, please.
All right, thank you. Follow-up comment by Tim on his previous question. He's stating that money growth in the year to June 2020 grew at around 25%, and that money growth in the 8 months to September 2022 was 0. So changes in equilibrium velocity are nothing as compared to that. That's his comment on your answer. I don't know if you want to say something about it.
I think Tyler Cohen also in the US was making a statement about M2 growth at something like almost 50% over some time horizon, which is related to the first part of that comment. And my response to that was to say, yes, it's true. There was a lot of information in that M2 growth. But at the same time, notice inflation's experience has not been so precisely predicted by that. So I think we did get some information from it, but again, I think we have to be maybe a little modest about how much information we're getting for near-term price level targeting. But again, I don't want to argue about this too much. I'm very open-minded about what we should do, and really want to focus more on getting the Fed as an institution back to where it needs to be as an institution. Because right now, frankly, it's a disgrace.
All right, thank you. Another comment by one of our master students here at the University of Buckingham. Would you like to know more about your views on the role of monetary policy or central bankers in general in determining climate change policy, especially in the current renewable energy generation scenario?
It's not their purview to determine climate policy. Climate is of course, a very complex topic that our government, in our democracy and in other governments, we trust that elected officials will decide to impose regulations, taxes, including a carbon tax, make their decisions about what they should do. This is not what the central bank is charged with doing. The central bank should not be given climate responsibilities or any other implicit fiscal responsibilities. When I was at the comptroller of the currency, we had a very interesting discussion. And we said, well, as part of our role as a bank regulator, and of course the Fed has a parallel responsibility under current law as a bank regulator, we need to come to grips with the question of whether climate risks pose risks for the banking system. Now, the truth was, the way that we had that conversation was we said, we understand that there's a lot of politics pressuring us and other regulators to pretend that there is a significant risk to our banking system coming from climate, but it's nonsense. So what we did was we simply decided at the time not to say anything about it because we didn't want to attract hostility from people who thought that bank regulation should focus on climate. I can tell you that the consulting firms that consult for bankers are making a huge amount of money on consulting for climate, partly because it's so politically charged. But there's frankly no there. I mean, banks simply don't face major risks associated with climate uncertainty, which is itself a medium-term problem. Corporations do, because the stock of corporations, the value of corporations, reflects these junior kinds of risks, right? The assets of the corporation can change. If you decided to locate, there's some good economic research right now showing that depending on the kind of land you might buy, you have been subject to some significant risks in terms of the depreciation of land relating to climate concerns. But remember, banks are senior claimants on short-term debt. They are not long-term claimants on equity. So thinking about climate risk, that's certainly a reasonable thing for us to do, to think about our whole economy and to think about corporations. But to think about the banking system facing some kind of crisis risk relating to climate, which is itself a long-term topic involving not just senior debt risks, is just nonsense. And I think it's a great indicator of how politicized the Fed has become, that the Fed feels the need, and other central banks feel the need to talk this way. And obviously, unfortunately, it's not a disease that only the Fed has experienced. You're feeling it quite a bit in Europe too. And,
oh yes, there is no consolation, but yes.
yeah. So of course, and I have, just as I like Chair Powell as a person, he seems like a very decent fellow. I think Christine Lagarde seems like a very decent lady. Unfortunately, I wouldn't say that she, in her discussion of this, she has shown much wisdom or sort of, let's just say, good economic insight. So it's very telling that we have people in charge of monetary policy generally who aren't very good economists. I think that is itself an indication of what a failure economics has been, that no one feels that it's neat. And you can forgive them. I mean, after some of the experience that we've had under economists as chairs of these organizations, you can kind of see why people might think that having an economist isn't such a good idea. But if we had a humble economist, maybe that would work better. An economist who got up and said, look, there's a lot we don't know, but what we do know is a systematic monetary framework would be very useful. It would be useful because it would help us all have a better discussion. It would eliminate the amount of disruptive news that happens. It would insulate monetary policy from politics better. It would improve our wisdom. It would reduce our politicization, and it would reduce overall the risks that we create. Now, an economist who could talk that way in public, taking advantage of the pulpit of these FOMC briefings that happen every 6 weeks, to constantly make that statement and to make it to the press, I think would be extremely helpful, and maybe would then make economics less of a failure as a discipline. But that's not what we've experienced, of course, at all. I also want to, before I've been sort of bad-mouthing everyone, I don't want to leave the press out. The big problem that we have with our media is that for you to keep your job as a Fed follower in the media in the United States, you have to have access to the Fed chair, who routinely slips them bits of information to make them look smart and to make them look informed, and Fed officials give them quotes. In other words, the people in the newspapers at the Wall Street Journal and the New York Times who specialize in reporting on monetary policy are extremely conflicted. They never really criticize the Fed because those Fed officials who give them access to information are absolutely their bread and butter. If the Fed were relying on a systematic monetary policy framework, that would change. It would also improve our press coverage, because the press would then be able to ask pointed questions about the systematic monetary policy framework, and they would not be as reliant on unpredictable discretionary ideas and therefore on the inside information they get from Fed officials. And it's been, again, an abject failure, the press coverage. Financial Times, 6 months ago, I tried to explain that having a negative real interest rate couldn't possibly be a contractionary monetary policy. And I won't name the reporter, but she didn't even understand what I was talking about. The quality of the coverage has been so bad. But I think if we can think of ways that all the ways that making monetary policy systematic would improve the intelligence of our conversations, raise the level of coverage in the press, raise the kinds of conversations happening at congressional committees, raise the level of the FOMC meetings themselves. This is where that's what we would get for making monetary policy more systematic. I know I'm just beating a dead horse, maybe, but I'm not going to give up.
Perfect. No, and I very much agree with you on that. I remember attending the so-called monetary dialogue of the ECB with the European Parliament, which is the equivalent to the congressional hearings of the Fed. And in the 2000s and up to the global financial crisis, the ECB's policies were much more predictable and very much followed the lines of the Bundesbank's policies before that. And I remember the chairman of the ECB at the time, Monsieur Trichet, just dismissing any question that would have any focus on their mandate, on price stability. That actually made him much more independent from the press, from politicians, from anyone willing to exert any pressure. You would just stick to the mandate of the institution. That was very easy to defend. That's price stability, end of. But we are very far from that era, may I say. And I'm afraid the situation in the US is even worse.
But maybe, Juan, that's a hopeful point too, because I think that, you know, unless you have major problems coming from the fact that these central banks have lost their way, which is reflected in this high inflation environment and the sort of clear incompetence that we're witnessing. And I think everybody understands that talking about climate and inequality and all these other fiscal issues, or watching the Fed intervene in the municipal bond market, or having the Fed pay, contrary to the statute, pay above market interest rates on interest on reserves to banks, which is a subsidy to the banking system. Those are all inappropriate fiscal policies and fiscal actions that show how far the Fed is from, and the other central banks are, from what they should be doing. So we see a combination of overreach and incompetence, and especially with inflation. This is when our opportunity exists to push for a systematic framework. If I were giving this speech 5 years ago, no one would be listening. No one would have invited me to give it. This is our moment. How we can get back to this, that's a strategic question we should all be really asking each other, how we can cooperate to actually make this salient politically on the table once again. But this is our moment. And of course, if history is any guide, we're going to blow it as we always do. That's unfortunate, but let's try to push a little harder this time, and let's try to come together and make these points that people have been making for 60 years, plus 60 years. Let's all make them the same points over and over again together. This is our moment, precisely because the incompetence and the overreach are so visible.
Okay, thank you. On the point of the Fed being the monopoly supplier of money and effectively controlling the price level, can you elaborate on it further? Is it because it's a question of confidence?
No, it's not a question of confidence. It's a question of a legal right. So ever since we went off the gold standard, and it's a little more complicated than that, because the Treasury in the 1930s also asserted some monetary authorities that made it effectively be able to control the money supply for a while. But since after World War II, I think we can say the Fed has had the power, because of its control as a monopolist over the supply of money. The Fed has had the power to make the price level go up or make the price level go down, because all the price level is the inverse of the value of money. So the value of anything is dictated by supply and demand, which means that if I'm the monopolist over supply, I can make its value move. It's really just that simple. The Fed controls the supply of dollars. No one else does. It's not about confidence, it's about legal right. They have the legal right, without anyone else's interference, to control the supply of dollars. It's really that simple.
Should the Federal Reserve keep it simple and just stick to controlling inflation instead of getting involved in wishy-washy stuff?
Well, I think that should be its primary objective, because we know we can hold it accountable for that. The reason I make a distinction between primary and secondary is we know there is no such thing as a long-term unemployment rate that the Fed can achieve. The long-term unemployment rate is determined by a lot of different real uncertainty, right? The Fed can't set the long-term unemployment rate, but the Fed can set the long-term rate of inflation. So that's why I make it the primary objective. But I'm also very much cognizant of the fact that the Fed has to have a secondary objective of countercyclical monetary policy, or some kind of rule, and it has to be politically realistic. So we have to be thinking, we can't just have the Fed acting as if no one cares about countercyclical monetary policy. It needs to do that. But beyond that, no. It shouldn't be trying to subsidize municipal bonds or subsidize banks with above market rates of interest, contrary to its own statutory authority. By the way, there's an interesting story. When the Fed was about to be called on it by members of Congress for paying above market rates of interest, the Fed triangulated. Janet Yellen met with Maxine Waters, who was ranking member in the House of Representatives, and basically did a favor for her to get Maxine Waters to back off challenging the Fed on the above market interest rate. And of course, the favor that Janet Yellen did was an abuse of her authority to give Maxine Waters her preference for the appointment of the president of the Atlanta Federal Reserve Bank. Now, that story is known by everyone in Washington, D.C. That when that happened, it was, of course, everyone knew that that's what had happened. Think about the fact that no one in the press reported on it. So many of you probably aren't aware of it. And then just think about how low we've come, that that's the way our Fed chairman behaves with a member of Congress. And that's the way Federal Reserve Bank presidents are selected. And that was all done as part of a political deal to avoid the responsibility of actually holding the Fed accountable to its own statutory limitations on interest payable to banks. I mean, it's so sad in so many ways. Sad as a comment on the chair, sad as a comment on Congress, sad as a comment on where we are in the Federal Reserve System structure right now, and how corrupt, really, the system has become.
Well, thank you. On that note, I think we're going to end the session. You've been very kind, giving us your time, not just in your presentation, but also taking plenty of questions from our audience and engaging with the staff of the institutes, myself, Tim, with our own comments. And I very much appreciate your presentation and your willingness to collaborate with the Institute. We may disagree on the specifics of the rule, but we very much agree that there will be a tremendous step forward to have something much more meaningful to tie the hands of the Federal Reserve and to make it effectively much more independent and predictable as compared to where we are now. So, Professor Calomiris, again, thank you very much. We'll follow the developments about your book very closely, and hopefully we'll be able to buy very soon. Thank you very much for your presentation.